Everybody keeps saying the same thing. Tech layoffs are happening everywhere, so housing is inevitably going to crash. And on paper, that seems completely logical, except there's one little problem. In most of the many desirable markets in California, prices did not crash. And in many cases, they actually went up, which is a bit of a head scratcher. So what the F is actually going on? Well, in today's video, I want to explain what I think is one of the biggest shifts happening anywhere in the country to the housing market right here in California. And here's a really quick news flash for you guys. AI is not creating more wealthy buyers. It's creating fewer buyers actually, but just with way more money. And that right there is what is changing the entire landscape for the California housing market. Now, before we get into the topic, let me quickly reintroduce myself. My name is Arjun Dhingra. I've been doing this crazy mortgage business and a career of it for the last 25 years. Most of those years right here in the San Francisco Bay Area market. And if me and my team can be of any help to you, like we have been for thousands of individuals and families that want to either invest or own a piece of this market, please reach out to me on Instagram at Arjun Mortgage. It's me that answers all of my own DMs, and I'll get back to you, and we'd be happy and honored to serve you in any way that we can in putting together a strategy or a long-term plan. We also put out a lot of great content on that channel, so make sure you're following me there as well. And if you could do me one more favor, guys, and please like this video today and subscribe to this channel because it'll help us reach more people with useful content about the California housing market like you. So first, guys, the big misunderstanding. Everybody thinks that the math when it comes to the California market is actually really simple. But what happened is that it changed. Most people think that the housing market works like this in a simple equation. More jobs equal more buyers, which equals higher prices. Or fewer jobs equal fewer buyers, which lead to lower prices. Now, historically, that's mostly true, but AI has completely changed that equation. First, let's look at all of the tech layoffs that continue to happen, but really started around 2022. You've had companies going a lot leaner because AI is creating efficiencies, and it's not necessarily eliminating jobs, but it's raising the question of, do we really need that many people doing this when AI can actually cover it? And because of those efficiency gains, companies are actually doing better with fewer people. And so this is why you have this head scratcher of why premium neighborhoods continue to go strong when it comes to the housing market, in spite of tech companies laying off lots of people, particularly right here in the Bay Area. I mean, think about that for a second. If thousands of people every quarter are being laid off, but the housing market and specific neighborhoods are continuing to go gangbusters, how does that make sense? Well, quite simply, guys, it's because this is a very resilient market. Yes, the Bay Area has lost a lot of people when it comes to tech workers, yet the prime housing markets have continued to not only hold the line, but increase quarter over quarter in terms of price point. And it's basically because housing demand isn't just simply about how many buyers actually exist out there. It's about how powerful or what kind of spending power or the punch that they pack that those buyers are carrying. And so my take on this now is that you're not just competing against people out there in the market. You're competing against one NVIDIA engineer with a stock package that looks like a small lottery ticket. Just let that settle in for a second. Now for the heart of the matter. Let's get into what the real focus of this video is and what I want you all to think about a little harder. The big premise out there for a long time, once AI kind of became a household term or expression, is that it's going to replace lots of jobs. But that's not what's actually happening. What it's doing is it's concentrating income. It's putting more dollars in the hands of fewer people. So yes, some jobs are being eliminated, but those that maintain or retain the jobs that are left are actually earning way more than was even imaginable when they started in those roles. So let's just make this simple, guys. Here is what the old model looked like. You would have a company that would hire 10 people and pay them $150,000 each. The new model is that AI allows them to operate with just 5 people. But now they pay those 5 people $300,000 to even up to sometimes $600,000 plus equity in the company. Same money, fewer humans, much bigger wealth concentration. So much like you have in the overall economy, and we've all heard this expression by journalists or economists that the middle is being squeezed when they refer to the middle class. And it's true. The same thing is happening right now with jobs in this space. So you have your middle being squeezed while the elite technical talent is becoming more valuable than ever. Other things to consider with all of this, guys, is the amount of equity compensation that these employees are being paid. There's RSUs, bonuses, AI stock growth, and all of the productivity gains that are being created by AI and increasing everyone's output in these places. One elite engineer today can produce what an entire unit or a division would do. And so that changes the compensation models dramatically. Okay, so you take all of this and how does that actually impact the real estate market? We're seeing it happening in actual real time here in San Francisco and the greater Bay Area as well. And let's not get it twisted, guys. A lot of these wealthy folks or people that become wealthy working for these companies, they don't leave their money just sitting in a checking account. They take action and do something with it almost right away. So as a result of all these people having all this money just sitting around, you've got much bigger down payments coming from these buyers. You've got people wanting to move up from their existing home if they happen to be owners prior to this explosion. You'll have some of them even wanting to buy a luxury second home in a totally different market, or this market if they're working remotely from somewhere else. There's cash offers because, what else should you do with all that money sitting around? Even this, which may sound surprising, which is family compound buying. People actually in big groups of families buying a place for everyone to live in. And this is happening not just in San Francisco, but in the Napa, Sonoma markets, as well as the peninsula. I'm seeing buyers come in with huge liquidity events that have just recently happened, massive stock appreciation, and huge bonus structures. And these buyers are competing aggressively, meaning they're swinging a huge bat with very limited inventory. And that's why this market, guys, feels so confusing right now. The broader economy might feel shaky, and there's plenty of news headlines to support that. Anytime you go on any of those major financial publications websites, they'll tell you all the negative stuff that's going on with the economy. Inflation's starting to tick up, consumer confidence is starting to wane a bit, people are upset about the war, they're feeling shaky about their job prospects. But the concentrated wealth at the top, the people that are earning money and continuing to make decisions, irrespective of all those headlines and all those data points, remains really, really strong. And speaking of the markets, it has basically split into two different groups. And I'm talking specifically about the housing market. The first market, or market number one, are your AI and stock-rich buyers. These are people that are looking in prime neighborhoods, they're shopping for luxury homes with amazing school districts, and effectively looking for that trophy property. These homes, guys, still move very, very quickly. Then you have the second market, which is probably going to be more representative of the broader buying market. These will be people that are more rate sensitive as buyers, meaning they're watching what's going on with mortgage rates, and that's having a big impact or influence on their decision. But they're looking at condos. They are entry-level buyers themselves. They're middle-income households, and they are stretching their affordability as buyers, which a lot of first-time buyers do. Now, I've worked with thousands, as I've said, over my 25-year career, and I've always told people that when you buy for the first time, it is a little bit of a stretch. You are gonna feel a little bit uncomfortable. Now, there's a fine line between being so stressed out that you can't sleep anymore and just being a little bit uncomfortable to where you have to second guess whether you're gonna go out and make that happy hour or eat out 5 nights a week versus now dialing it back to 2. You guys get the point. And so this is why one house will get as many as 8 offers sometimes, and another one's gonna sit there looking lonelier than MySpace. Now, I wanna give you guys some very important advice here, because blanket or general housing advice in today's market is extremely dangerous right now. And I'm talking about the headlines telling you that it's either a terrible time to buy, or that the market's going to collapse, or that you should really second guess any type of a move into real estate. Remember, above all, guys, the strategy is going to be the most important thing. Yes, timing's important, but if you have the right strategy, you're going to be able to insulate yourself from anything that may be a little bit bumpy out there in the future ahead. And above all, you got to remember that the Bay Area kind of marches to its own beat when it comes to housing. California in general, but specifically the Bay Area. So here are some strategy points that are really going to help you if you're looking to break in. Number one, you got to remember is that flexibility wins. You got to be adaptable and flexible in how you're going and approaching these properties, and not using a rigid one-size-fits-all approach. So who you work with really matters. Next is you want to remember that condos and townhomes, which have been a little bit softer, might offer a much better entry point. Look at secondary neighborhoods as well. Yes, they are the ones that everyone are always keen on, and those are the most crowded. But sometimes looking at a neighborhood that's just adjacent to that people seem to be overlooking, will offer you tremendous value, and you're still at a stone's throw distance to that popular neighborhood. And above all, guys, do not assume that every market behaves the same. Some San Francisco condo segments, for example, are still trading near pre-pandemic pricing. Meanwhile, there are certain luxury pockets or neighborhoods that don't even care what's going on with mortgage rates. So your strategy matters more than ever now, guys, because the markets are not moving in sync. Every single one of them march to their own beat. So here's what this means for you if you are an actual homeowner. Now, if you own real estate anywhere in California, first of all, congratulations, because getting in is no easy feat. It's a major accomplishment, and you've probably done pretty good on the asset since you acquired it. But recognize this now, guys, is that your zip code matters more than ever. There are lots of movements going on, particularly with demographic shifts. And so this could be affecting your zip code for the better. Keep in mind what's going on with schools there in your area. Are they improving? Are they getting more crowded or less crowded? Because this is going to be a big driving force as well. Look at the income concentration. With all these good paying jobs, Are more of those people moving into the area where you live, or are they leaving it? Also bear in mind, again, what this whole video is about, which is AI proximity. A lot of these people will have jobs that are either in the space or related to it, probably want to live in proximity to where they're going to work for those jobs. And then lastly is luxury demand stability. Is that happening in your zip code, or is it starting to deteriorate a bit? Because at the end of the day, your home value is tied to who can actually afford in your neighborhood. So in wrapping this guys up and looking at the big picture, no, I don't think that AI is creating a broader housing boom. I think it's actually creating a more unequal housing market, which is stronger at the top, softer in the middle, more bifurcated, and much more fragmented. And quite honestly, we're still very early in this whole shift, if you want to call it that. So the people that are out there who follow all of the doom porn, or they're doom and gloom people in general that are waiting for a collapse in the housing market, they're going to likely be very disappointed, because so many parts of this market, as I've talked about today, are being fueled by the extraordinary wealth structure that's been created now and continues to march ahead. So if you're trying to understand as an owner where your neighborhood fits into all of what I've discussed today, or if you're a buyer that's looking to break in and you want to be very selective about where you invest your money, reach out to me and my team. Again, you can find us on Instagram at Arjun Mortgage, and we'd be honored to help you in any way that we can. Remember guys, in this market, broad headlines are effectively useless. Don't get suckered by them. Strategy matters more than it ever has. Thanks for watching guys, and we'll catch you on the next one.